We saw a massive rally in Bitcoin yesterday, and it's continuing today. We've broken up above 24,200 odd, 24,300. And this is definitely a sign of risk off. Despite all the economic indicators, despite the threat of further inflation, despite a buoyant economy, despite all the words of Jerome Powell, the markets are risk off at the moment. The CNN Fear and Greed Index is showing us just bordering on extreme greed. We're at the level of 74. Get over 74 to 75, and if we rally a little bit today, we will get over 75, and we'll be moving into extreme greed territory on the famous CNN Fear and Greed Index. So we've got Bitcoin rallying, we've got the Fear and Greed Index moving into extreme greed, we're seeing stock markets rallying, we're seeing a complete ignorance or ignorance of what's going on with pending recession, with retail sales going up, with job numbers at extreme levels, and CPI also showing that there is some resilience in the CPI. It's looking like it might become sticky, and we're certainly not moving down at the rate we were a month ago. And there is definitely cause for concern that the Fed might have to raise interest rates faster again, and certainly over a longer period of time, and that they won't be pivoting or reducing interest rates anytime soon. So it's risk off for the markets. VIX is really low, and actually yesterday and today it has collapsed back down to this trend line. We're not seeing any blowout in volatility at all. It's just steady as she goes. And in fact, if we break down through this trend line, we can expect this to move a little lower. We can expect the markets to continue to edge higher. Well, we've seen what happens when the markets shrug off news. Despite all of that, we've seen, and perhaps because of that, we've seen the CPI, inflation rates rising. We've seen the Federal Reserve raising interest rates bit by bit, and also proclaiming that they're going to carry on doing so until the job is completed. And yet the market has shrugged it all off and continues to go higher. So if we have a look at the NASDAQ and the S&P, S&P and NASDAQ both moving up beautifully and holding to their trend lines, holding above even the 20-day moving average, which is very bullish, just moving up higher steadily and steadily as she goes. And there doesn't seem to be any inclination for this market to reverse at the moment. Now on the NASDAQ, we've got this W bottom that everyone's looking at, and we've got a top of this at 13,500. That'll complete this W pattern that you see on the chart right in front of you. It's the NASDAQ day chart. Well, I suspect we might try and reach up there. All we've got to do is break through this top green area, which is the Fibonacci retracement. That's actually the 38% retracement. And it would make sense to go to the 50% retracement of the entire down move since the beginning of last year. And that would mean a huge rally in the NASDAQ, and we've already seen this move up by, so far, just this year, we've moved up from the bottom 21% in the NASDAQ. And that's a huge move in just a month and a half, a month and 3/4 maybe. And if we have a look at S&P, same sort of thing. We're holding above the 20-day moving average. We're holding above this recent trend line. We've broken above the highs, these resistance levels here at 4140. Next stop is 4,200, and then probably 4,320, 43,000 would be quite something. And that would take this rally from right in the beginning, the lows were actually in October last year, up until where we are at the moment is a 20% rally as well. So massive moves up in the stock markets, even though it's just moving up incrementally, it's moving up steadily and surely. And we're seeing a significant move up. In line with that, really, we're seeing dollar index starting to move up simultaneously. This is quite unusual. So we're seeing dollar index rallying, and we're seeing the stock markets rallying at the same time. So one of them is going to give. Either the dollar has to move lower, probably. It's not a fixed rule, but one would expect as interest rates rise, the dollar will continue to gather a little bit more strength. The stock markets should react in the opposite direction, as the economy is meant to be failing, but it's not. We are seeing some layoffs and a few other negative indicators, perhaps in the housing market. But overall, particularly in the services sector, we're seeing strength despite dollar strength continuing to muster up the beginnings of a new rally here. Now, this rally I think will take us up perhaps to 105 on dollar index and maybe 106.50 up to these moving averages. This is the 100 and the 200-day moving average. That looks like a really good target, because when you get a 100 and a 200-day moving average confluence, that forms a super strong resistance area. If we put on a Fibonacci from the top down to the bottom, we can start to see these retracement levels in terms of Italian mathematics, I suppose. And you can see that 106 level. Not only is it the confluence of those two moving averages, let's just get rid of this line I've just drawn in, but it's also very close to this Fibonacci. And I guess these moving averages, by the time we get up there, if we do get up there, these moving averages will move down. So that's a really key level. That's the 38% retracement level, and that is at 106. We're at 103.50 now. So that's, well, 2.5%. It's about 2%, 2.1%, something like that, which is about a 200 to 300 pip decrease or decline in the euro and the pound. But for those trading stocks, looking at where the stock markets are likely to go, all I can say is that there's no reason to think that we've got anything other than a rally on our hands. That could get up as high as 13,600 on the NASDAQ, and we could even get as high as 4,200 on the S&P, and maybe even up as high as 4,300 before we start to see some correction. And even then, it might just be correction. So it's risk off. So having said all of that, you might ask, what am I about to do with these markets? Well, I trade stocks, I trade commodities and Forex and metals. And I don't know what's going to happen in the stock market, so I'm staying away from it as much as I can for the moment. I've got small positions short on the S&P, but they're small positions, and you've seen my analysis. I'm not too sure that we'll find any relief or correction anytime soon. But what I can see in front of me is a dollar index that looks like it's got support above its 20-day moving average and above that horizontal blue line that we've been looking at for some time now, almost 2 weeks now that we've been looking at that. And I'm hoping for a rally up to 105 at least, which is this first resistance level, and then 106, which we talked about earlier in the video. So I'm trading currencies predominantly for the moment, and I'm short on the euro, I'm short on the euro CAD, and short on the pound as well. And the other thing is I'm trading a few commodities. I'm trading some soybeans, I'm trading some sugar, and I'm trading some natural gas. Stock markets, I think we have to be very careful. It's no time for FOMO, no time to be leaping into long positions, because we have extreme greed. And extreme greed normally follows a market correction or a blowout before that. And so it's no time to be leaping into long positions with big size or into short positions with big size. And we'll just have to let this play out as it goes along. So I hope that's been helpful to you. And if you do like this video, please just subscribe to the channel, press the like button, press the notification bell, press anything that you can find really. It helps the channel, helps encourage me to produce more of this sort of content for you.